You know the gain in our kind of life is being able to recognize a good idea when you rarely get it, states Warren Buffett. Despite the abundance of information on their investing tactics, two of the most well-known investors in the world, Warren Buffett and Charlie Munger, are renowned for their unparalleled success and investment acumen. Surprisingly, many investors still don't adhere to the tried and true procedures. Today, we'll discuss the method that has enabled Buffett and Munger to create the ideal compounding portfolio. The secret to doing so. By the time this video concludes, you will have a rudimentary understanding of their approach and have seen their potentially exceptional portfolio, which comprises of the top 8 compounding equities they own, having done so for decades. First, let's discuss two of the world's most influential investors, Charlie Munger and Warren Buffett. I'm sure you've heard their names a ton. Surprisingly, though, not many people really use their tactics, despite the fact that they have been extensively examined. They are the masters of compounding stocks, picking businesses that appreciate exponentially over time. Let's now look at some figures that, as an example, may simply blow your head. Consider Apple, whose stock has increased by more than 15,000% since 2001, making the tech giant the largest holding in Berkshire Hathway's portfolio. Additionally, Buffett has regularly invested in Coca-Cola since 1988, and the company's dividend payments have significantly boosted Berkshire's overall returns. These illustrations highlight the significance of selecting businesses that have the capacity to expand and hold their worth over time. Under Buffett's direction, Berkshire Hathaway has outperformed the S&P 500 in a way that draws attention. We're talking about a rate of return that over decades may turn a little investment into a fortune, but it doesn't take magic. Rather, it just requires patience and strategic long-term planning. In the pandemonium of the 2008 financial crisis, all you really needed to have was the courage of your convictions and the willingness to act when everyone else was terrified. Buffett and Munger were coolly choosing their battles and making prudent investments while the others were fleeing for their lives. Buffett offers simple guidance. This tactic helped them not only get through the crisis, but also made money when the market improved. Be scared when others are greedy and greedy when others are fearful. The companies who not only lead the pack but completely reinvent the race are the ones you need to find. Let's begin by discussing what it means to be the greatest in the business. Take Apple as an example. With over 1.65 billion active devices worldwide, it's more than simply a company. Their control over the smartphone industry is unparalleled, particularly in the US, where they often dominate more than half of the market share. It's as though they've established their own empire. Let's move on to the idea of a pricing model. Netflix is a prime example of this. Over time, they have increased the cost of their subscriptions while maintaining a steady member base. Simply keeps increasing, with revenue reaching a staggering $25 billion by 2020, from just $1.36 billion in 2010. Netflix demonstrates this if you provide value. Your customer won't mind spending a little bit extra if they understand that what makes your good or service unique makes it irreplaceable. Operational efficiency is another important component. Amazon has demonstrated what can be done with smart management by growing from $34 billion in sales in 2010 to an astounding $386 billion in 2020. They have also wisely scaled up by entering high-margin industries like cloud computing, which has greatly increased their profit margins. Finally, let's not overlook the significance of consistent demand. Procter & Gambler's a 5% net sales increase in the fiscal year 2020, indicating the need of having items that people always need. It's about making something that becomes an essential component of day-to-day living, and debt sustainability is also crucial. Consider Microsoft. They've handled their debt so well that, even though they have the ability to take on more debt, they've managed to keep their debt-to-equity ratio remarkably low. This shows that they've taken a balanced approach to expansion, making sure they're not over-leveraged, yet nevertheless prepared to take decisive action when needed. Finally, Buffett's own Berkshire Hathway is a shining example of efficient asset flow. The book worth of the corporation increased from $19 per share in 1965 to $261,400. This is an excellent illustration of prudent capital usage and strategic investing. As a result, choosing firms involves more than just looking at the numbers. It also involves comprehending the meaning behind them. Businesses that dominate their industry, have pricing power, enjoy steady demand, prudently manage debt, and allocate assets wisely are the ones that endure. And those, my friends, are the Buffett and Munger methods for creating a portfolio that is not only strong but built for expansion. Let's now discuss attitude execution before beginning your investment. It might be difficult to travel with the correct mindset, which is why attitude execution is crucial, especially if you want to emulate the financial success of titans of the industry like Warren Buffett and Charlie Munger, whose success isn't merely a result of their decisions. Their strategy and mindset towards investing is firmly ingrained. To start, let's talk about consistency. The daily highs and lows of the stock market can easily throw one off. However, Buffett and Munger maintain the course. They don't base their decisions on the whims of the market. Having a sound strategy and following it consistently is what separates mediocre investors from exceptional ones. It is a well-known fact that some people find it extremely difficult to apply the lesson of following reason over emotion, while others find it easier. Next, let's put reasoning ahead of feeling. Here's where Buffett and Munger stand out. They approach investment with a cool, calculated logic. They assess, analyze, and act based on reason rather than emotion. Investment may frequently feel like a high-stakes game of poker where emotions run high. In addition to what I like to refer to as tomorrow thinking, this methodical approach serves as a safeguard against the market's volatility by guaranteeing that every decision is based on sound reasoning rather than irrational emotions. Here's where vision meets patience. Buffett is renowned for having stated that the purpose of the stock market is to move money from the active to the patient. This says all you need to know about thinking ahead. True compounding is known to take time. It's not about making immediate gains. This way of thinking is about acknowledging that some investments require time to mature and start to really pay off. It's about seeing beyond the horizon and the possibility of what lies ahead. Because of their long-term outlook, Buffett and Munger have been able to take advantage of opportunities that others might have missed because they were too preoccupied with the here and now. Currently, executing the proper attitude involves combining logic and consistency with a forward-thinking viewpoint. It involves applying patience, reason, and steadfastness to your approach and decision-making. It is these three characteristics that support Buffett and Munger's illustrious performance. It goes beyond what you put money into. It's about shifting from an investing perspective to the technical aspects of investing and how you approach those investments. Finally, we get to asset handling. This is the point where Charlie Munger and Warren Buffett's concepts are turned into actual plans and activities. The term handling assets is broad and covers everything from how you organize your portfolio to when to buy and sell. It's critical to have a clear plan for each asset, understand its place in your portfolio, and make adjustments as necessary to ensure that everything remains in line with your long-term objectives. What I like to refer to as asset structure is one of the essential elements of assets handling. In order to achieve this, you must assemble a focused, diversified portfolio that strikes a risk-reward balance that aligns with your investing objectives and risk tolerance. Buffett and Munger excel at this. They concentrate on businesses and industries that they are well-versed in while ensuring that they do not place all of their eggs in one basket. This strategic allocation of assets enables them to respond to market fluctuations and seize opportunities as they arise. Finally, proper value assessment is where the analytical side of investing really shines. This involves periodically assessing your assets to make sure they continue to meet your growth, value, and potential goals. This process is critical to making wise decisions about whether to hold onto an asset, sell it, or acquire more of it. To truly follow in the footsteps of Warren Buffett and Charlie Munger, it's a moving process that requires you to be attentive, patient, and detail-oriented. You must not only comprehend their tactics, but also observe them in action. Let's examine those top 8 compounding stocks in more detail so that we can get to the core of their investment philosophy. These stocks could form the cornerstone of your ideal portfolio. Let's start with Apple Incorporated, which is known as the tech industry's golden child for its innovative ideas and products that people can't live without. These qualities have not only kept the company at the top, but have also generated steady demand and assets. Apple is a prime example of a compounding stock because it is more than just a company. It is a revolution that never stops. Bank of America Corp. is a well-known name in the banking industry. Given its strong financial health and effective operations, Munger and Buffett would not be enthusiastic about this kind of business. Coca-Cola is another name that conjures up images of strength and global demand. Its ability to maintain a pricing moat in the very competitive beverage industry is nothing short of remarkable. Buffett himself places a high value on the brand's strength and market leadership. The financial services industry is led by American Express. It is a crucial component of a well-rounded compounding portfolio, not just a card in your wallet. Even though Kraft Heinz Co. has seen some difficulties, its sustainable debt model and effective operations make it an excellent illustration of the long-term demand and effective asset flow that Buffett advocates. Your ability to recognize value in investments is evident as you are placing a wager on the perpetual need for food and other necessities. Verizon Communications Incorporated leads the telecommunications business, exemplifying what it means to maintain a prominent pricing mode in a crucially dependent on demand. It's the kind of business that maintains both actual and figurative global connectivity. Because of its distinct position in the credit rating business, Moody's Corporation offers more than just a price model. However, it also runs ATES efficiently enough to meet all the requirements for a high-demand, debt-sustainable company. Finally, Buffett's progressive strategy to entering the electric vehicle and renewable energy sectors is exemplified by BYD Company Limited. It's a satire on the future, highlighting its potential for organic expansion and leadership in the field. These 8 businesses are more than simply equities. They speak for a well-established, methodical, and strategic approach to portfolio creation. As we approach the conclusion of our tour through Charlie Munger and Warren Buffett's investment theories, investing in such compounding equities isn't just about following in the footsteps of the greats. It's also about positioning yourself for long-term success in the always-changing market landscape. It's becoming evident that their success is not coincidental. Rather, it stems from thoughtful choices, a resolute mindset, and strategic asset management. The key question is, how will you put these into practice? Which of these compounding stocks or methods speaks to you the most, and how do you plan to incorporate them into your portfolio? Share your ideas and tactics in the comments section below. Timeless principles for your own investment approach. In conclusion, adopting Warren Buffett's approach to building a portfolio entails a disciplined and patient investment strategy rooted in fundamental analysis and a long-term perspective. Emphasizing quality over quantity, Buffett advocates for investing in businesses with enduring competitive advantages and trustworthy management. Diversification, while important, should not come at the cost of diluting one's focus on well-understood and high-quality investments. Moreover, investors should embrace market fluctuations as opportunities rather than obstacles, viewing stocks as partial ownership in businesses rather than mere ticker symbols. By adhering to these principles and continually seeking to expand one's knowledge, investors can strive to build a resilient and successful portfolio following the time-tested wisdom of Warren Buffett. Kindly share, like, and subscribe to the channel to obtain further educational videos.